Hey guys, Frank Curzio here, another live video. I say this all the time, but I love your feedback. FrankCurzioResearch.com. You guys know I've been negative on Disney for a while, and I just saw them report earnings after the close. So I'm getting a lot of emails and stuff like that. So I wanted to break it down because Disney's results. Here's a stock that went from 70 to a little bit over 100. So I thought, considering that move, that you need to report pretty good numbers to support that move, and Disney did exactly the opposite. They beat on revenues and actually said that direct to consumer and international revenues for the quarter increased from 1.1 billion to 4.1 billion, which includes the assets for 20th Century Fox. Uh, but segment operating loss increased from 385 million to 812 million. So they said the increase in operating loss was due to costs associated with the launch of Disney Plus and the consolidation of Hulu. So basically, what this company is telling you, the more subscribers it adds to their Disney Plus, the more money they're going to lose, right? And that happens in streaming across the board. So this is a business that they're not going to make money on for a very, very long time, even if they have 150 million subscribers. I mean, to put that in perspective, they expect to spend 5 billion for new content when Netflix has 180 million subscribers and spending 17 billion dollars this year in content. So you need to spend a ton of money. And again, this is an industry that just never makes sense to me in terms of, for us it's great streaming, but to make money on this business that has no pricing power and everybody's rushing in. I get why Disney's doing that, because they want that constant revenue stream that Disney gets, Comcast gets from wireless and things, and they don't really have that. So that leaves the rest of their division, which is parks, which is theaters, and none of it, I mean, none of that stuff is open. And not only that, when it does open, the traffic that they're going to see is so much less. So they reported they missed earnings by 40%. I mean, it was kind of a kitchen sink thing when 90 cents was the number. They brought that all the way down. They earned 60 cents for the quarter, which puts their forward PE this year at 44 times. I've never seen a PE for a company that high for a company that's not growing and not expected to grow in the next 2 years at least. So, but doesn't matter, right? That's what the title of this was. It doesn't matter because, today you get rewarded for the more crap you report, the better it is for your stock and you should buy it. If you remove guidance, you get rewarded compared to someone who just lowers their guidance and actually gives a forecast of 2020, which is insane when you think about it. But for Disney, a lot going on under the hood here. I mean, they can't hide it no more. They're losing lots of money right now. So let's see how this plays out. Again, I don't hate Disney personally. I just think it's incredibly overvalued. This is a stock that could decrease full 50% and still be one of the most expensive stocks in the Dow. So just be careful with this name. I don't see a reason to buy. It's going to be interesting to see what the analysts say about it when they come out. The conference call is probably going to go on. I think it starts in a little while, about 4 or 5 minutes. I'm going to be listening to it. It's going to be interesting to see how they even keep the dividend for this stock. But let's see. We'll see tomorrow. Based on this market, it should be up 20% tomorrow. So we'll see. But in all seriousness, and I think Disney's a lot of trouble. They're going to have a bad few quarters, and I don't think that's priced in the stock, trading over 144 times forward earnings. Frank Curzio, as always, I'll be back to you guys soon. Take care.